Hey everybody, my name is Cedric Harding, and I'm bringing to you for the month of, well, I'm not going to say the month or the year or anything like that, but I just wanted to do a video on why buy permanent insurance. Now, I'm not making this for life insurance agents for training. I'm just doing this for the public in general because most people, when they come to me or we're talking amongst everything, TikTok, Facebook, or whatever, everyone's talking about whole life or infinite banking, be your own bank and things like that. Now, I had a video that talked about the four types of insurance: term, refund of premium. You get IULs, index universal life policies, a whole life policy, a universal life policy. There's things called variable. All it term or something that's going to last you for the period of your lifetime. So I just want to do a quick video about it. Want to talk to you about it. I may draw some things on the board. And today it is Sunday, and I'm rocking my Justin Fields jersey just to celebrate him. I'm a big Justin Fields fan. So with that, let's get started because you didn't come here for that. So imagine the one of the things that I always talk about is what's the longevity of your family? What are you talking about, Sad? You know, what is the longevity of your family? Like, when you really look at it, you know what's going to happen in life. We're not here. We're like um, we're here temporarily, right? As they say, God is our travel agent. We're here, then we're gonna go somewhere next. Okay, so when someone, what's the time frame of family? How long have people lived? To 87, 93. Some people have grandfathers that live to 101. What's the average time frame? Because some people will get a term policy because it has the cost, but unfortunately, it expires. They go from the longest 30 to or 35 years. There's a company called Kansas City Life. That's one that I'll offer to as well, where they'll give you one for just a period of time. And it has cash value. We'll talk about that one. There is a term that has cash value, but it does cost you a little bit, right? From Kansas City Life. You talk to me about it. I have it in a portfolio, but I don't want to get off topic. I want to talk because it's a term and it's going to expire. So if we talk about the lifetime of family of health, taking consideration what we're eating today, taking consideration of things that's going on in the world, we just don't know. So in my family, the average lifespan of everyone is usually between 85 to 90. Well, I haven't had anybody that's lived past 90 years old. And hopefully I may be the first, or or something may happen. I watch Terminator and all that stuff, Skynet. Anyway, with all this AI stuff. So imagine having a lifetime policy. Let's say I'm 43 right now. So 43, and then we have this time I want to take this to age 100. So if you have a permanent policy, most permanent policies you will pay that up to age 100, right? And then sometimes this will also take you to age 121. Now, there's nobody's really realistically going to be working at Walmart or something when they're 101 years old. If you just want to go out and volunteer. But when you have a permanent policy, there's a lot of things that happen in between. Okay. Now that's where this term policy comes into play. So, within a 30-year time frame, you've on the or between 43 to 100, I want to go through a lot of things in my life. I'm going to own a house. I'm going to get a car. I'm going to get into some debt. I want to buy some things. But then watch the series where I talked about term. I talked about living benefits. I talked about my son Cameron and how I could have used all of those things. So I won't watch living the video on living benefits so you can see why. Now you don't want to just go out there and get used to living benefits with your permanent policy, right? Now, that's something that I used to do when I first started out as an insurance broker. I said, hey, get an IUL and get that IUL for $50,000. I want to have to hit on this. 50K and it had the living benefits in it. But what if something does happen? What they advance 45% of this 50K that takes it down. So now you want to have a term policy that can help with the health part of it, the emergencies and things like that when you're living. But when you have a permanent policy, one of the things that I use is the ROP, the refund of premium. So when I'm 53 years old, I'll have $33,000 coming back to me. A refund of premium is a permanent policy, right? It does expire when you take the money, but it's really like a savings, right? I use it. That's my way of explaining it to the general public. It's like a savings account. So I put in just about whatever that amount is, and then on the 15th, 20th, and 25th anniversary, it will actually I can actually cash that money out, but it expires. I need something that's gonna last me a lifetime. Because let's say when 43, let's say when I'm 53 years old, I still got a time frame to go. What's gonna cover me in between that time frame? If I take this refund of premium, right? Now you have the whole life policy, you have a universal life policies, you can slap the IUL and all the other stuff, but it all want to how can you take advantage of that? So you can take advantage of the permanent policy. You can take advantage of the permanent policy by turning it into something that's called alert life insurance retirement plan. All right, look, I almost put two R's. Life insurance retirement plan, right? Life insurance retirement plan. So what happens with that, instead of when you use the IUL or you use the whole life, and then you want to, sometimes people create banking methods with that too as well. Maybe I can, the average retirement age is around, 65, 67 years old. It could change. But right around this time, let's say 68 years old. I don't want to work. I don't even want to do be on Zoom. Zoom probably won't even exist. I'm 43 years old. What is going to get me right here to where I want to work? Start working. Am I going to depend on the government? I'm a veteran too as well. Am I going to depend on the government? Social Security is going to be wrapping up by 2037. You can go on a website and it will tell you, hey, it's going to eventually run out. And a lot of the younger generation, they're not working like they used to. Everybody's getting into entrepreneurship, which is something that you should do too as well. And a lot of people just don't work. They don't want to work. They want to sit at home. We're not going to talk about that one. So you have to come up with something. The life insurance retirement plan. Look, I erased it, but I'm going to put it back up there. So you can come up with your own private pension is something that you can have that can pay you out so you can survive at that time. So what is the longevity of your family? So if I actually could create something that I can pay into from 43 to age 68 to take me to 43 to 53, 53 to 68, what could I use? I could use something called cash value life insurance, right? So something that has value in it where my money can make money, which is something that you want. You want your money to make money, you want to make money tax free too as well. So then look, I have a business, I have several other things, but when you put it into the life insurance retirement plan, guess what? Can I sue you? Tell me what do you have if you have real estate. If I wanted to, unfortunately people do go through divorce. Unfortunately, there are people out there that just want what you have and they want to sue you. Can I go out there and take their real estate from you? That piece of property that you can I sue you for your word because that has value? Can I sue you? Can I touch that? Right? Can a significant other, family member, or friend come after your assets that you have? Is the stock market safe? The stock market has its ups and it has its downs, right? What is protected by code 7702? This is insurance, the I that's in there. The insurance part is protected, right? And so when you have money going into that, it's you have your 401ks. We'll talk about that in another class, right? And I'll bring in somebody specifically for that so you can do your 401k rollovers. But you have this. If I had a policy, a permanent policy, because I didn't talk about it, let's say it's 100K, right? 100K. Now, if you have a policy that has cash value in it or is 100K, you can do something about called write this down. You should have notes or take some paper out. There's things out there called viatical settlements where you can, if you got 100K term and it's convertible, yep, the bank will buy that, right? If it's convertible, if it's 100K or more. If you have a permanent policy, whole life, universal life, variable, all of those things, and it has cash value in it up to a certain amount, that is considered an asset. Now, the viatical settlements, I did say that, but there are some rules to that. Okay, you can reach out to me, and I'll put my link at the end of this so you can find out about it. But this 100 is focused on this 100K. If you have 100K, right? What if I can borrow from that 100K? Right? What if I have a policy that's set up where if I have an emergency, I can borrow from that. But let's say I had 30, let's say I realistically had 20,000 in K. 20,000 in cash value. 20,000 in cash value, but I don't want to I got this 100K. Depending on the type of policy that you have, let me borrow from this 100K. Right? Now there's percentages that you can only take a certain percentage from this 100K. There is they do have instead of borrowing from the bank, borrow from your insurance policy, your alert. And you can actually borrow from that 100K. I won't get into the numbers, but it may say, okay, well, we'll charge you 5% interest, 4% interest. Is based on the type of company that you're working with. All right. And while you're borrowing from the 100K, the 20K is still making money using other people's money. Right. Or you can remember this, if you got cash value growing, right, in your policy and the permanent policy, I'm not saying the type of, I'm saying permanent. Every agent knows what that means, right? Something that's going to last a lifetime. That means if I take money out between 43 to 53, I take something out, I can still put it back. I can still put it back. I can still put money back into that policy of what I borrowed. Okay, said, well, what if I pass away and I take 20K from the 100K? All right, well, tell you what, when you pass away, they're just the death benefit is going to pay out minus what you did not pay back, right? Or while you took out the 100K, I think I said it before. This 20K is still making money, or the 10K, or the whatever the money that's there. What if I tell you if you had your permanent policy? Give me 1 second. Let me do this because I don't like having all this scratch up here. You don't have to sit here and start with 100,000 and things like that. It's okay if you have a child. Let's change this right here. Let's leave that 100 there because it's always going to be there. It's permanent. Let's say you got a 2 year old. You got a 2 year old beautiful child, right? And there's a lot of things that's going to happen. And let's say you started the child off with 50K. Now there's two types. I'm gonna give you this nugget. There's two types. They got something called level, and they have something called increasing. Right? I've sold both. Sometimes this 50K when it's level means it's gonna stay the same way. This if you can, I'm gonna draw this right here. The level is gonna, if you see that, it's gonna stay the same the whole time, right? If you're doing an increasing, the death benefit and the cash is gonna just, going to gradually grow all the way up to age 100 to the time that you start paying it, or just based on the illustration, right? So I just gave you that nugget. So you need to ask your agent: is my policy going to be increasing? Is it going to be level? So sometimes you don't want it. You don't want that just that 50K. You got to run the numbers, because sometimes you may feel like, oh man, I can outpay. I put more money. I get that all the time, especially in certain neighborhoods. I put more money into it what it was worth. All right. When you start making more money than what it's worth, then dividends and all of those things start happening. But okay, let's say the 50K is level, right? Stay 50K the entire time. And you say, hey, my 2 year old, I only want to pay this until they're 30 years old. You can actually pay this to a certain age and leave it and don't have to pay it anymore. You can have paid up additions, right? You can also say, you know what? And remember, if you're the parent and you got a 2 year old, you actually own it. It's not the 2 year old. You actually own it. So you're actually making money. So you can create that $1 million baby and investments and things like that. But if you do increasing, this 50K could grow to 60K. It could go by the time the child turns 40, this 50K can grow to probably 100K, right? And that's hypothetical. I'm just making throwing a number out there. But it's a permanent policy, because how long when you paying on it for a period of time, all the way up to the age 100 or age 60 or 70, we can come up with a cutoff date. But what do you want it to do? Do you want to retire? Do you want a savings? Do you just want? I'm gonna be keep it real. Do you just want the death benefit? I just want to, when so and so pass away, I just want to take care of the burial and things like that, right? So there's all types of permanent policies that'll cover you, no matter where you start. Right here, no matter where you start, it's gonna take care of you all the way to that number right there, right? So if you're interested and you want to learn more about permanent policies, what they can do, what you can get out of it, how you can make it work for you with whatever the premium is, because I can't. Insurance is based on age. Okay, insurance is based on age. So what I wanted to pay, from what I know now, I should have paid. I told you I was 43. I should have figured this out. I wish someone would have actually told me this when I was 38 or 30 or 20, right? Or told my parents when I was young and set this up for me, then I could have had that retirement plan already done. Right? So we want to put ourselves in a position, so when we hit I'm gonna write this age back up there. This 67, that's just gonna be the magic number. What do you have in place right now when you hit 67 years old? What's gonna be paying the bills? Is it gonna be, are you gonna be working? Are you dependent on Social Security? Where basically you may just be getting 2,500, $3,000 or less from the government. And don't don't go and think that you can just move in a senior home, because they're going to reduce what you can have. You got to talk to me about that one too. We're going to talk on that subject, right? But what are you going to do by the time that you have 67? Do you have your own private plan? Right now, I do annuities, retirement plans. I'm just talking to you about the versions of what insurance can do, the life insurance retirement plan. Let's talk about it. Reach out to me. You can text insurance to 224-407-4888. If you want to text me and say, hey, man, that I don't know why the Bears traded Justin Fields, you can find me on social media. My name is Cedric Harding, CedrickHarding. You can find me my public page on social media or Legacy Smart Group. All right. So looking at that, I'm going to drop my link below, and I look forward to speaking with you. Let's sit down. I have like a just block off a 30-minute time frame. I'll do a presentation with you where I explain everything from A to Z. That way, you have an understanding of what's in your neighborhood, what's not, how money grows, the three ways that money grows. All right, I explain all the different vehicles of insurance, and based on what your age is, if you're in your 60s, then you may be in a Pinto. That's that vehicle that you're in. Final expense, they have that where you be like, man, I just want more. Just understand everything's based on age, and they not gonna because the closer that you get to this, the tougher it's gonna get. The further away that you are, the lower the premium, the more that you can pack into this retirement, the more that you can pack into the savings, and the more that you can transfer when that comes. All right, my name is Cedric Harding. Thanks for enjoying this short video. And let's get down to it, and I'll be more detailed, and I might even put on a tie for you. So I look forward to hearing from you. Thank you.